This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Peaks Investing podcast. This is podcast number 129. It is the 12th of June. It's just gone 6 p.m. And today, as you can see, if you're on YouTube, which you should be by now, it is myself and Henry Viola Air at HT Viola. We'll be hosting this particular podcast today. And we will send our best wishes to Phil Oakley, who is currently under the weather, and we hope to see him soon. We'll keep you posted on Phil's health and progress. But here we are. You, me, Henry, holding the fort. We're going to talk the markets, going to talk some stocks. Where do you want to go with here? What's the conversation you want to start with, Henry?
Well, I mean, first of all, like you say, we do hope we see Phil back soon. Being a great contributor to the pod, so we're missing him this evening. But I think for me, the last 2 weeks really have been scouring the markets looking for opportunities, and they're springing out at me left, right, and centre. I've got a policy of looking to buy shares at discounts to their intrinsic value. I like that idea of buying things. Buying a pound for 50p is the common saying, and I think there's opportunities like that all over the place at the minute. Earlier this month, you might have seen the news about the National Grid offer that came out. Yep. There was a rights offer from National Grid.
Yeah.
Now, I imagine everybody listening to this podcast will know that National Grid is the UK's power network operator, and they announced a £7 billion fundraise to help finance a 5-year, $60 billion investment plan. Sorry, £60 billion investment plan. Absolutely mammoth. Now, due to the way they're going to raise the capital, I believe they're doing a rights issue. The shares immediately fell off a cliff. I think they dropped like 15% on the day. And my first thought was, I kind of want to get out there with a wheelbarrow and start buying some of this, because it's been a £10 share for as long as I can remember, if not worth more. Now, you've got to take into account that there is going to be the rights issue, but this is a business with a great moat, a great monopoly in its field, a great track record of doing business in the sector, and it's an integral part of the electricity grid. You can't really replace it. So there's a lot of characteristics I like about it. I need to do a little bit of research, of course, on figuring out just what impact this rights issue is going to have on the number of shares in issue, because that will permanently impact the value. But you've also got to take into account the fact that this investment plan ought to improve revenues and profitability for the company. So for those of you out there looking for a bargain, I think it's time to crack out the spreadsheets and get hunting.
Yeah, it's an interesting one. They came out. I think what happened was they surprised the markets, Henry, with this, what you say, a bumper fundraise, 7 billion to raise to help finance a 60 billion investment plan. And people are thinking, right, okay, first and foremost, they're going to invest how much? 60 billion. So the share price just gets absolutely smashed from 10.5 quid down to more or less 8. I'm not sure where they finished or where they are at the moment. So that's people always go, what price is it going to be at, and so on and so forth. The level of what we call dilution, as the number of stocks they're going to have to put out there to actually get that. And since then, people have been trading the rights issues. Some people have taken up the rights and so on and so forth. And I'm looking here and looking at it and saying the official deadline to subscribe for new shares is 11 a.m. on the 10th. So that's just gone 2 days ago. So yeah, should be very, very interesting that. So are you saying you've now purchased some shares free rights, or what?
I have.
Did you do
so I've not bought them through the rights issue. I've actually bought them on the open market.
On the open market,
sorry.
Okay.
But I have bought a little bit. And And I've got a lot of faith in this company. I used to own it years ago, and I sold it. And it's one of the few shares I've sold that I've really, really regretted selling. And I've been looking at it for years, going, kind of wish I'd still got that. And I didn't want to buy in at the price it was at. And now here I think is a buying opportunity. So I've taken it.
Okay, so the shares are sitting at the moment at 8.77. Yeah. In the past month, it's come down from when they made that announcement. It's currently sitting 15% from where it was before.
Yeah.
So it's not too bad. You always talk about the utility stocks and all the rest of it, and this is literally a utility stock. It's one of them that just slowly plods away. Market cap of 42 billion, looking to invest 60. Even after this rights issue, I'm thinking it's going to be carrying some debt.
It is, you're right, but I think it can service it as well. I mean, they have got effectively a monopoly on the industry. And it's the sort of industry as well where the government can't let this go bankrupt. So they are going to be backstopped by the government no matter what. Incidentally, I don't think there is any risk of them going bankrupt. I think they can service their debt fine because they've got quite good visibility of their revenues. When you think about a lot of businesses where customers can walk in the door en masse and then walk out the door again en masse a year later if they don't like something. Much harder to do that with something like an electricity grid. I think
it's not possible.
Exactly. There you go. You see, we all want energy coming out the power sockets when we flick the switch, and they provide that facility effectively.
Yeah, so we're on a PE of just shy of 16, divi yield of 6.6% to keep people happy, whilst they're waiting for this to return back to 10 quid. So you're looking at potentially, if and when it gets back to 10 quid, you're looking at what, 20% plus 6% yield, 25%, 6%, 26%, if and when it gets back to where it was prior to the fundraise announcement.
Yeah.
Which for a sleepy sort of stock, if you're getting that over the next, if you break that down into 3 years, compounding at 7% a year, it's not a bad return.
That's my theory.
But you'd be hoping for a bit more. You'd be hoping for a bit more than that. Yeah, an interesting call there. But this is the difference here, Henry. You are, for all intents and purposes, a long-term investor. So you're not looking to trade this out for when it bumps back to 10 quid. You're looking to hold it for a little while.
Exactly. You see, I also think there's a huge opportunity with the incoming government, whoever it will be. We suspect Labour, but anything could happen.
Do you say we suspect Labour, or do you suspect it will be Labour?
I suspect it will be Labour. I think it will be a landslide. I'm calling that today, folks. Please don't come and egg my house. Anyway, keeping off the topic of politics any more than that.
I'm not going to go there. Don't get me going there, mate. Because I will say this one thing, right? The conversations I've been having with regards to certain people, is the level of shock that people have got regarding people in their workplace, people where they've been out socializing with various other people, and even some people commenting about certain people on Twitter, X, amongst what we call our FinTwit, who are championing Nigel Farage and the Free Reform Party. And I'm going, whoa, you know what? Not going to get into that discussion with anybody, because that's a whole different ball of wax. Because they're simply giving up on the Conservative Party, and they're going to go to, I don't know. Anyway, that's all I'm going to say. So if you see anybody that's championing the Reform Party, you know enough already about that particular individual. That's all I'm going to say.
Yeah, I'd echo that. To come back to my point, I think regardless of the machinations on the right-hand side of the House, the left-hand side of the House, you've got a large block of MPs that want to green the network, if you like. They want to reduce carbon emissions. There's an enormous drive for more renewables plugged into the grid. There's an enormous drive to reduce coal-burning power plants, gas-burning power plants, to also to electrify the road network with electric vehicles and the like, electric buses. And all of that is going to require investment in National Grid.
Yep. Agreed.
The network is going to have to be upgraded to cope with this increased demand. And so to me, it's the place to be. It feels like the place to be. I'm quite optimistic about it. And
Okay,
unlike
well,
some speculative businesses where they're going to cure cancer tomorrow, for example, and never quite manage it, I feel like I've got reasonable certainty with National Grid that we're still going to be using electricity in 5 years' time.
absolutely. Well, you have found favour, Henry, in your choice, because just today, and this might be this might come back and slap you in the face because of who it is. It's not Jim Cramer, but Goldman Sachs have come out and said National Grid is a buy, and they've got their price target of £10.59 versus today's price, up from £10.07. So if you've got the backing of Goldman Sachs, usually that's a good call, isn't it?
I'd like to think so. But I think
Brilliant.
for me, the wider point is there are these opportunities out there, folks.
Yes,
National. I'm not saying
agreed.
go out and buy National Grid because I bought it. I'm saying
Yeah,
keep your eyes peeled because there are these enormous value opportunities that suddenly spring up, and you've got to be ready to pounce when they do.
but you need cash, Henry.
You do need
You need to
cash.
have some cash on your portfolio. So if your portfolio makes up 100%, you're going to have 5% or 10% sitting there,
Ready to
almost
go.
to say, oh, it's doing nothing, to be able to go and pounce. 3% of your portfolio in cash to be able to pounce. Waiting on dividends to drop in or whatever to buy some of this and buy some of that. As I said to you before, and I said on this podcast, it may not be enough. £100 of that share may not be enough. You need to be able to go in for that opportunity and go wallop on it and sit back and wait for the market to agree or disagree with you. Because as you say, the opportunities are there every single week. There is a takeover, right? We're recording this on Wednesday. There'll probably be a takeover before or two before the next podcast in the UK. Yeah, the UK stock market, FTSE and AIM. And it's going to be averaging. The average has gone up from last year at 33%, nearer to, I think it's 47, 48% from beginning to end. That's how wide the premium is getting now. Yeah. So the opportunities are there. And we tend to go, oh, buyer's remorse, or, oh, I looked at that before. But most people want to buy the stock, yeah, when it's going up or near 52-week highs. And I've said this before and I'll say it again. There is no safety in the crowd. Yeah. The consensus and the herd will get it wrong as much times as gets it right. And you will get a better return by doing your own research, thinking completely objectively and independently, and being brave enough to go with your own judgment. Yeah.
Spot on.
So yeah, but thank you for that. Right. Interestingly, I'm going to just briefly go back now, Henry, and talk about the markets. Today we closed at 8215, and we've been almost at near a month low since we spoke with Phil on the pod, and Phil was saying he's very bullish. He thinks the market's going to hit 9,000 this year, and I went, mate, listen, we've been sitting here for a long time trying to get to 8 and above 8 from sevens. Yeah, we get to 8. We've had the high of 8,474. I'm not so sure. I want to be positive, but I'm cautious. We actually hit, Henry, before the US markets, and I think it was, I want to say Intel, I may have got the name wrong. The US popped this afternoon. We hit 8,147. Right? That was the intraday low. And we closed, thankfully, up after the US market set a pop at 8,215. So we need to not be getting any nearer to that 8,000 level, because if we get a really poor summer, we could breach that. A really tepid summer, we could breach that. Any bad news, we could breach that. And we don't want to go below 8,000 because that'll just hit sentiment entirely on everybody else across the board. And unfortunately, we lost the 800 mark for the FTSE All Share, FTSE AIM All Share, sorry. And that's at 787. That was up 0.75% today. FTSE All Share still above the nice 4,000 level comfortably. It's at 4,482. That was up 0.86% today. So fingers crossed we stay above that 8,000, that 4,000 level on the FTSE AIM All Share and 8,000 on the FTSE 100. But like the stocks out there still, as you say, completely undervalued, and there will be more and more takeovers. Right. Where do you want to go, Henry, regarding I'm conscious that we've not spoken for a little while, and I want to get this in early so we get people thinking about it. About the fundraise that you're helping with. Yeah.
Fundraise.
We should have mentioned it last podcast, after we had our brilliant guest at Flying Finance, when Andy absolutely came on here and smashed it like a boss. And he's had some fantastic feedback from all of the individuals that decided to reply and give us feedback. So I want to say a big thank you to all those that have engaged with us, engaged with Andy, followed Andy's Twitter account at Flying Finance, and gave us feedback on YouTube and also on Twitter X. So please continue to give us feedback regarding this pod and continue to follow Andy. But charity, mate, charity. Where are we at with it? What's the levels? Who's recently given? And we're going to talk a bit later on about how we can continue to encourage people to do that.
So, yeah, for those of you that are tuning in perhaps for the first time, I haven't tuned in for a while, Peter, Phil and I are raising for Centrepoint this year. Every year we ask our audience to donate a little bit of money to a charity of our choice, in return for a twice weekly podcast, which you can tune into, which we hope you enjoy. Certainly we get some lovely feedback on it. And this year we are raising for Centrepoint, which is the UK's leading youth homelessness charity. Now, it's been a few months since I actually talked about youth homelessness in much detail. Usually I just go through the figures, but I just want to remind people what this is all about, because it's very easy for me to just canter through the numbers and say thanks and we all forget about it. Now, Centrepoint as a charity supports over 16,000 young people in the UK every year that are either facing youth homelessness, or are actually homeless. Now, some of these individuals are in schools and they are facing difficult times at home with families that perhaps can't support them or are emotionally or physically abusive towards them. Some are forced out into the world of work far younger than they should be, because the parents can't afford to bring money in for food, for bills. And as a result of that, they end up getting exploited. They end up in some terrible situations. And like I say, Centrepoint is currently aware of over 16,000, is actively supporting over 16,000. And in a country like the UK, that really is quite shocking. That we have to have accommodation services across London, Sunderland, Manchester, Bradford, Barnsley, on and on the list goes, for people that really ought to be having the same start as you or I were given in life, but due to a quirk of their circumstances, are just facing terrible, terrible situations. Now, Centrepoint provides a whole raft of support and advice, not only shelter for the youngsters that are facing homelessness or suffering from homelessness, but also education, training, support and advice to try to stop them ending up homeless in the first place. Sometimes it's working with the families to help them get back on their feet. Sometimes it's working with the children to help rebuild relationships. But really, it's all about changing a path that they're on that doesn't have to end with them on a park bench somewhere or worse. And this facility really, I think, ought to be available to absolutely anybody. Any child in this country should not be facing homelessness. It simply shouldn't be the case. Now, this year, Peter, Phil and I are aiming to raise £5,000 to support Centrepoint. And that money is going to go directly towards helping some of those 16,000 children, possibly even more, that really, really need help. And it's very easy to feel as though it's someone else's responsibility, it's someone else's problem. Times are tough, the cost of living crisis is kicking in. It's not my problem. But out of an audience of 4,500 that we have on this podcast, if everybody gave just a few pounds, we would smash that target to pieces and we could help hundreds of young people avoid homelessness. Surely that's something worth contributing towards. Now, in that vein, we have had 51 contributions from various members of the audience over the first 6 months of the year. Some of the most recent ones have come in. We've had a very generous £100 plus £25 gift aid from our friend Roger Green, who came on the show a few episodes back. Keep podding on, guys. You're doing a great job, and well done on choosing another worthy cause for fundraising. Long-time supporter,
thank you, Roger.
N20, donated £50 plus £12.50 gift aid. Up the Toffees, Glenn. Another good show. Well done, guys. It's great to support a worthy cause. £30 plus £7.50 gift aid. Our friend Andy, Flying Finance. Enjoy the podcasts. A wealth of knowledge shared. Cheers. And the very generous Kevin Taylor has been back. £100 from Joanne and Kevin Taylor. Best of luck hitting your target for such a great cause. Now,
fantastic.
The reason I list these off isn't to go, if you don't give £100, don't bother. It's just to show that we've got members of the audience that want to contribute and want to support. Even if it's only a few pounds, it doesn't matter. But please do consider sharing a few pounds for the charity. And hopefully we can help some young people to get a better start, get back on their feet and avoid that terrible spectre of homelessness. If you don't have the link, it's available. The fundraising page is available at www.justgiving.com/page/Twin Peaks Challenge 24. That's Twin Peaks Challenge 24. All donations are gratefully received.
Brilliant. Well said, mate. And thank you to everyone that's donated so far. Did you give us the balance, Henry, as to where we're at right now?
We are
How close are we? What percentage have we raised so far? You've raised?
We're just under the halfway mark. 49%, £2,497 raised from 51 supporters.
Brilliant. It's a good start. And we're literally halfway through the year. So if we carry on that sort of vein,
keep on the momentum, we should get there.
It'd be lovely to get 100 people at least donating and cracking that £5,000 and giving that to Centrepoint and helping some youngsters that need some better situations for themselves going forward. Yeah, mate. Well done. Well said regarding that. And thank you to everyone that's made a donation so far. And if you can, please make that donation. It's not coming to Henry. It's not coming to me. It's going to go to some youngsters that need some support. And Centrepoint are a fantastic vehicle to be able to do that.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
Okie dokie, Henry. I'm going to talk about, I've been talking about a lot of consumer related stocks of late, and big data is a massive part of that. And AI, as you know, I love AI. So I'm going to talk about a stock now that could and should be on people's radar. And some people might think, actually, it's not one that I'm that keen on. But for me, it's a very interesting stock, especially given the number of customers that they've got. And I know this is probably not going to be one that Henry is going to like, but I always like to just pique Henry's interest regarding some of the stocks and make him have a little think and maybe come over to my little side of the fence regarding some stocks that are not as higher quality as what he would possibly prefer. So I'm going to talk about a stock which not a lot of people will be aware of, but should be aware of because its name is synonymous with AI and SaaS and large cap companies. And that company is Eagle Eye Solutions, and the ticker is EYE. So first question is, what do they do and what piques my interest? Well, I'm going to start with what piqued my interest first. And this goes back to April of this year. And Eagle Eye Solutions, I better say it rather than I, because people think I'm talking about myself. Eagle Eye Solutions were selected by Tesco to power their club card challenges. And Eagle Eye is a leading SaaS company that creates digital customer connections enabling personalized real-time marketing. And they secured an additional 1-year contract with the option to renew a further year with Tesco Stores Limited, which obviously everyone knows is the UK's leading supermarket. And this is for its AI-powered personalized challenger solution, building on its existing relationship with Tesco. So what you've got is the digital platform of Eagle AI. It allows retailers to personalize promotions, providing customers with customized challenges designed to reward incremental behavior. Yeah. Inbuilt AI with deep machine learning facilitates hyper personalizations through its analytics capability, providing customers with promotions more suited to them. So it's personalized. So if you're a sort of person like Henry that likes to go into the shop, yeah, and likes to buy a particular brand of goods, yeah, every now and then they'll reward Henry regarding that particular brand of goods, regarding what he likes, yeah. However, if it's his missus, you know, his boss, Verity, that loves a nice luxury chocolate, yeah, the AI personalized for Verity's card will give Verity some discounts or bonuses regarding, you know, here's, you know what, Verity, you've not purchased some chocolate for a little while. Here's a little discount. Go and treat yourself. Oh, we know it's your birthday. Here you go. Treat yourself. So yeah, that's the stock that I've got my eye on. I don't own it at the moment. We've got a 52-week low of £4.30. We've got a 52-week high of 605, and it's currently sitting at £4.09. I'm going to go through some stats here, which I've just pulled up on my phone off SharePad, so that you guys can start looking at the financials regarding it. And across all the brokers and all the other people talking about this particular stock, they've currently got a target price. I don't really go into target prices because it's just like a target that almost never gets hit sometimes. But
I think it's a nice way of saying guesswork, isn't it?
Yeah. Oh, you had to go there. You had to go there. All right. Okay. So target price at £9, right? So that's 83% above where the share price is right now. It's a stock with only a market cap of 145 million pounds. This is where Henry's going to go. Sorry, what did you just say? Forecast PE of 43.2. Yes, I knew you'd pull a face at that one. PEG, which is where it gets a bit easier, of 0.6, which is good. Where are we at with that? Debt, Henry, which you're going to love, is 0.
Ooh.
Yeah, debt to market cap 0. Okay. No divvy on this one as yet, which is another negative. And we've got a 5-year CAGR, right? Bearing in mind it's not really done much for the past 2 years. The 5-year CAGR remains at 21.6. So having fallen 21% in 2022, it's fallen 15% in 2023. And right now, this year to date, it's pretty flat. But interestingly, this is the other little thing that piqued my interest, right? Very recently, Lion Trust Investment Partners, fund manager, bumped their investment stake up from 5.14% up to 10.17%.
They doubled their holding.
They're holding their stake in this little £145 million company. They effectively doubled it recently. Why? So those are the sort of things that pique my interest. Am I as smart as the fund managers across the UK? Absolutely not. Right. So if they're, I'm not saying all fund managers, before you all shout back at the YouTube channel and various different platforms you're on. Yes, we know all fund managers aren't ultimately the smartest people. Most of them are, though, right? So they're smarter than me anyway, and they're qualified to give advice, and they're qualified to pick stocks, and so on and so forth. Have they all managed to exceed the stock market over the past 3, 4, 5 years? No, they haven't. Get back to my point. Lion Trust fund managers have decided in their wisdom to double their stake in Eagle Eye Solutions, ticker symbol EYE. Why? Is it worth further investigation? Maybe. Will the shares rocket in the next 2 or 3 weeks? Probably not. Right? Will they do well over the next couple of years or be taken out at a premium? I don't know. This is for research. I'm not here to ramp anything I own. I'm just sharing some information. Henry, rip it to shreds, mate. Let me know what your thoughts are on II.
Well, it's funny you say rip it to shreds, because actually you've really piqued my interest. So this, to me, this is a Peter Higgins classic. You've come out of left field with a name, and I've never heard of that. But why have I not heard of this? What an interesting company. I mean, the success story I know in this space is Nectar Card.
Yes, of course.
Little family-run business. They had huge success. Eventually, Sainsbury's buys them out for a huge amount of money. Happy days and wonderful things ensue.
Yeah.
I'd got no idea that there was anyone else in that space. I'd never even heard of this firm. Really, really interesting business. And interestingly, I was talking to my father-in-law at the weekend about this whole trend of charging people different prices depending on whether you've got a loyalty card or not. It's now getting really noticeable. And I shop at Sainsbury's, and it's like, yeah, a pint of Guinness is a crate of Guinness is £17 if you forget your Nectar card. It's £13 if you've got it. You know, that's an extra pint I'm missing out on at the pub.
As you jumping back in the car to go back and get the cards.
Exactly. So
the beauty about this company, though, when you do a bit of digging, is the multitude of blue chip global companies that it's got on its books and it's working with, right? Because they're all trying to it's all about customer retention and gaining new customers as well. Yeah.
Well, there's a few things that jump out at me on it. I mean, one is the forecast growth. So as soon as you mentioned PE and PEG, so PE is quite a basic measure. It's just price to earnings. Doesn't take account of growth whatsoever. Now, a PEG ratio, I was once told that really you want to be buying companies at a PEG ratio of less than 1. This is the price to earnings ratio divided by growth.
Yeah.
Now, the fact that the PE is so high, but the PEG is under 1 says to me this thing's forecast to grow a lot. Yep. And sure enough, forecast earnings per share growth of 207% according to SharePad.
Yep. I was going to save that. I was going to save that until the end, Henry, but you've gone and took it.
I'm stealing that, mate. I'm stealing that. Now, in honour of Phil, I am also going to have to flag the quality metrics here at the bottom.
Flag the reds, mate. Flag the reds, of course.
Well, there's a red and a green, which is interesting. So members of the audience that are good with their numbers, please do come back and tell me your thoughts on this one. We've got a negative return on capital employed of minus 2.9%, but a positive cash return on capital invested of 31.9%. Now, I've got no idea what causes that difference, but that's quite substantial. I usually expect those two numbers to be more or less in line with each other. So again, I think this is a business that's worth moving past the headlines and getting under the bonnet of the financials and the forecasts and where the revenue is going to come from and what they're spending it on, because I think this is a really interesting company. And like you say, the fact that Lion Trust's just doubled their ownership, they think it's got potential, and they've got Bloomberg terminals and all the rest of
it. They absolutely have. So the beauty of it is, Henry, it's got world-class companies that it's working with, trying to engage. Powering loyalty is what they're basically looking for, and customer engagement solutions. And you've got Asda, Tesco's, Waitrose, John Lewis, JD Sports, Pret a Manger, Woolworths Group, you know, the one that's still in existence in, I think, mainly Australia and a few other places. So I'm looking and thinking, have I missed something here? I don't own it. Yeah. But I'm looking at it and thinking, I need to have a further look at this one. So that's where we are with that one, mate. Yeah. So
I really like
loyalty
it.
cards.
I think that's a cracking research idea.
Yeah. Data is the new gold, mate, and AI is going to fuel it. So that's one I wanted to talk about today. Right. Where do you want to go, and what's the topic you want to talk about now, Henry? Or should we talk about the winners of the challenge? Where do you want to go?
Yeah, let's go
to
for the challenge. Why not? I
go for the
like giving
challenge.
people prizes.
Yeah, can I, if you're going to go there, can I just interject firstly, right? And I want to talk about our good friend Mike McGeever on this podcast, because Mike kindly said to me back in March when, well, not, I think it was later than March, when we announced the winner for March, that he would kindly donate it to Memphis. And backwards and forwards. Anyway, it's not happened, right? So I went back to Mike and said, look, Mike, we've still got this particular prize of yours, which you kind of gifted to Memphis. They've done this big raffle thing, which, you know, they didn't put this prize in, so it's too late to do that now. I don't want to keep it until next year or whatever. There are some worthy people out there that potentially would really, really want this prize. And Mike McGeever of Powder Monkey Brewery, as he's such a gent, he is, and said, Pete, yeah, give it to that person who you think is worthy of it. And I've decided to give this prize to at Gallon73, who's a massive supporter of the pod, and not just give it to him because he's a nice guy. He's worthy of this prize because he came second in the month of March by a smidge, right? And so, Gallon, we've already had conversations, and I'll be making sure that the March prize for the Twin Peaks Challenge is sent to you, which was you choosing a book and you getting a month's subscription to SharePad ShareScope. So thank you again, Mike, and congratulations to at Gallon73. And hopefully his luck will continue in the new football season, which starts in August, September time, with it, because he's a Toon. It's part of the Toon army with Newcastle. So we'll wish them well. Over to you, mate. Give us some more winners.
Very well done. Very well done there. And also, I do quite like that idea of, you know, our audience being generous with each other, not just generous towards the charity and generous towards us, but generous towards each other. That's what I like to see. And so thank you very much, Mike. Very generous of you.
What's my mantra?
Kindness.
Kindness matters. Yeah. Give stuff, do stuff unconditionally, and good things happen.
Very true. So, on to oh dear, sorry, ladies and gents, I'm afraid the hay fever is getting the better of me at the minute. On to our three winners for the month of March, and as Peter's always telling me off, we're going to do them in reverse order this time. So no rap on the knuckles, please, Mr. Higgins. So in third place, with a 24.4% return for the month, is at Tigers Revival. The portfolio including VLX, FNX, WJG, ZTF, and Future Publishing, FUTR. Very well done at Tigers Revival. In second place, with a return of 24.8%, is at Chef Trader 2. Barely a hair's breadth between the two of you there, with a portfolio including PRD, TYM, PXEN, ATM, and KOD. Interesting mix of tickers there. There's a few I've not come across before. But it gives me great pleasure to announce that in first place, tearing ahead by a metric mile, with a return of 39% for the month of May, is our friend Nicholas Vaughan, with a portfolio including Bellascura, Tech Capital, East Imperial, XP Factory, and Shield Therapeutics. And the real outstanding one there was the little small cap, Bellascura, which went up 83% in the month of May.
Wow. I don't know what to say to that, mate. 39% in the month of May, which was quite a difficult month, I thought. You know,
I wasn't too bad in May, personally. I was
okay, but towards the end, it sort of started to tail off, didn't it? Remember?
But I think that's because April was such a rip-roaring month.
Yeah. But yeah, Bellascura, yeah, interesting company. I think they've just come out with a fundraise today as well, so I don't think it's going to be knocking the doors off in June. But yeah, very, very interesting. We had a conversation earlier about this, and it doesn't appear that Nicholas is on Twitter anymore. So, Nicholas, if you are listening via YouTube and via the normal channels, please get in touch with us via YouTube. Leave us a message on there, or contact us by email, so we can get these prizes out to you. You deserve it. You've entered the competition. We'd love for you to have this. We'll give you a little while, a month or so, to get in touch with us, and hopefully we can sort this out for you. If we don't hear from you, eventually we'll have to maybe give it to the individual that's come second, which is at Chef Trader 2. Your thoughts on this, Henry?
Yeah, I think that's reasonable. I mean, Nicholas has been a very generous supporter of our show for
Absolutely
a long time.
Has, yeah.
You know, we get a lot of great feedback from you, Nicholas. It would be a shame if we're not able to give you your rightful prize. So please don't be shy in coming forwards. And I hope your absence from Twitter is simply an absence from Twitter and not a sign of anything worse. So we'll look forward to hearing from you.
Absolutely, mate. Right. You've talked, Henry, about the markets being the way that they are. I'm going to quickly talk about a stock, and this is actually one that I own. But the reason I'm talking about it is because it's got a fabulous sort of write-up from our great friend Algy Hall at Citywire, when he talks about elite companies and fund managers buying elite companies. And just for absolute transparency, because I'm not on this podcast to ramp my own stock. This is a stock that I bought some time ago now, back in September of 2022 at 91 pence, and then trimmed a lot of the stock at 148 for a 62% profit, including divvies. And then I repurchased some more at 101 to between 113 last July. And given this particular write-up, which I only spotted today, I'm probably going to start buying some more of it. The stock I'm talking about is Jupiter Fund Management. And Algy, in his wisdom, has written an absolute belter of an article on it. So I'm not going to spend all day talking about it. I'm going to advise you guys to go and have a read of it on Citywire. And it was written on the 7th of June. And the article is called Top Contrarian Managers Back Rock Bottom Jupiter. Yeah. And it's basically saying Jupiter's had its problems. It needs to address its valuations. But some of the world's best investors have been drawn to it. The shares are down 30% in the last 12 months. The 12-month low happened on the 9th of January of this year, which is 71 pence. The 12-month high is 128, still below where I trimmed it some time ago, and it's currently sitting at 77 pence. So I'm not going to harp on about it too much, but you've got some significant individuals globally that have decided that it's oversold, and its assets under management is going to get a bit of a rebirth, rejuvenation, and so on and so forth. So I'm not going to say too much about it because I don't want people to come on here and say, oh, look, he's finally starting to ramp his own stocks. So have a look at that and tell me what you think. I'm just going to give you some metrics on it here now. Let me just give you some metrics on it so Henry can start assassinating this particular one. Won't talk about price target. We'll ignore that. Market cap of the company is 395 million. So it's a nice, easy, small portion to be consumed by somebody else, which could potentially happen if it stays at this lowly price. Forecast PE of 7.8, forecast dividend of 6.5%. Roche, which is what you talked about just a few minutes ago, Henry, is at the moment only 1.4, so that's really quite low. And we're sitting at a margin of EBIT margin as well is low, 3.3 rather than the 3-year average of 30.6. So not great. And earnings per share is down significantly, as you can imagine, if it's sitting near multi-year lows. So what attracts me to that, and why am I still holding it, and why am I looking to add, is because we're going to go through, from what I'm reading everywhere, significant change in the next 12 months of IPOs and the UK market being boosted by lots of transactions and inflows the problem with Jupiter, as well as lots of fund managers, wealth managers, etc., over the past, I would say probably 18 months, if I'm accurate, has been outflows. You want a fund management company who is seeing inflows, meaning that companies, institutions, retail investors are buying more of their funds, not less, not outflows. So once the outflows cease, this gets a re-rating, and the other fund managers and wealth managers get a re-rating. If they don't get an increase in inflows, this gets taken over. Yeah. Or they will look to bolster their inflows by merging with somebody else, or buying somebody else, or bolting on something else. And there lies the catalyst for Jupiter. Go on, Henry. Get the guns out.
I mean, geez, what a dog of a company.
Don't start gently. Just come in there and hit me on the chin, mate. Oh my gosh.
So,
what a dog of a company. Did you hear that, folks?
I've looked at a lot of wealth managers over the years, and a lot of asset managers, because they all look crazy cheap, but they've all been getting cheaper and cheaper. And the big problem they've got is that assets under management are just cantering out the door at an alarming rate. And every 6 months you get a trading update from them. Oh, don't worry, we've lost another 500 million, but next quarter will be better. Don't worry. You know, and then our star fund manager left, but don't worry, we're going to replace him, and we've lost another 500 million.
Yeah.
And at the same time, costs are going through the roof. I mean, I don't know if any of you are fund managers, so again, please don't come and egg my house. But fund managers,
we do have some fund managers listen to this podcast, and we do. So tread carefully now, okay, before you assassinate all of them.
They tend to be ladies and gentlemen of refined tastes and large paychecks. I'll put it that way. And in a world where costs are going up at 10% a year, I can't imagine many of them are saying, "Oh, don't worry, I'll just sit tight." So I imagine costs for Jupiter are also climbing at the same time as assets under management are falling, which isn't really a great combination. Now, having said that, I do own a couple of asset managers. I don't think the better
ones. You own the better ones, don't you?
Well, I don't want to say that, and I'm not. You can throw rocks at all of them, because as a sector, it's a car crash. You know, you're really hunting for. I wouldn't call these deep value, but they feel like deep value to me. No one wants them. Metrics are getting worse. But at some point, maybe some private equity firm comes along and goes, "Oh, I'll have that." Someone made a pass for Hargreaves Lansdown the other day,
which surprised everybody. Yeah, we spoke about
as we were saying. No one knows anything about it. No one wants it. I'm an idiot for owning it, or used to own it. And then all of a sudden, oh no, we've got that wrong, and the shares spike. And I could see the same thing happening with Jupiter. Not specifically Jupiter over anybody else necessarily, but I'll just tell you a little story. I think it was on your other podcast, Investing Matters. Yeah. And you were interviewing somebody who was talking about Jupiter. I think they were a wealth manager, or they used to be a wealth manager. And they once got a phone call from somebody that was absolutely adamant that they wanted to put a small fortune into the Planet company. And he said, "Well, hang on a minute. What do you mean the Planet company?" "Well, I don't know. I just saw a picture in the paper. It had got a planet on it. I want my money in that, please."
Yeah.
And that sort of brand recognition, this story goes back 40 odd years, but the brand recognition, you know, he'd spotted it in the paper. They got a graph of their returns over 10 years. It's a very old institution, Jupiter, very well recognized.
It is.
A lot of brand value. And I could see someone coming and snapping it up.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and Annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the Twin Peats promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
So interesting business, but buyer beware, because just because it's cheap today doesn't mean it's not going to be cheaper tomorrow.
Absolutely. And this is the sort of stocks that I prefer, Henry, where people like yourself are going, no way am I going there. And the majority of people on Twitter are going, oh dear, what's he thinking? That's when I'm looking. I see people in the RNS feeds in the morning going, what a crock of SHIT that is. And I'm going, let me have a look at that. What's that about? Let me have a look at that. When they're all ramping the same stock, I'm going, not interested. Not interested. And then I wait to see the stock just roll over 5, 10, 15%. And then they're going, why is it rolled over? Because everyone that's been ramping it is now selling it. You know? So, and I won't mention any names, so I know some people get upset. But you've got Jupiter currently, Henry, at trading at 0.2 times sales, and almost half of its NAV, give or take a couple of percentages. Going back to where you started the conversation, right? I'm now able to buy almost £1 of assets for 55, 60 pence. I'm happy to wait and earn a divvy yield of 6% whilst that 50% narrows. Yeah. And if I'm wrong, take it on the chin, take 1% off my portfolio, move on. If I'm right, double my bubble, sleep easy at night. I'm not going to wake up with a 50% fall on the stock because someone's decided, there's another profit warning on a speculative stock which nobody wants to know about. So there you go. Not for you, Henry, but for me.
Well, I'm going to trade you one fund manager for another fund manager here.
Okie dokie. Let's see if you can convince me, mate.
So, ladies and gentlemen,
and sorry. Before I stop. Before I say anything more, obviously I'd held the stock for a couple of years now, but that prompt was via Mr. Algy Hall at Citywire. Go and look at their elite companies research. It's absolutely phenomenal. And kudos to the Citywire team for all the quality information they keep putting out. Sorry, Henry, go for it.
Oh dear, I definitely second that. Big fan of Algy's work and his team's work for that matter. But I will trade you one fund manager for another. So on FinTwit, there's a rabid debate going on. Jupiter's better, no Lion Trust's better, no City of London Investment Group is better, mine's bigger than yours. Ladies and gentlemen, I know you're all very excited about your shares and you think you've got the next best fund manager going, right? And I love the passion with which you defend them. But have you ever looked overseas at the opportunities that are available? Because I looked at the UK and I thought this is a tiny percentage of the global wealth management business. Now, for various reasons, I quite like the Swiss economy and I quite like the Swiss financial sector. Very old, very prestigious, known for its conservatism, unless you're called Credit Suisse and you're going bankrupt, but let's not go there. And I came across a business that was founded in 1890 and it expanded significantly in 2005 when it acquired 3 Swiss private banks and the global asset management from UBS. And in 2012, and this might give the game away for anyone in the industry, but in 2012, it acquired Merrill Lynch's non-US wealth management operations, increasing assets under management by 40% and increasing its footprint outside of Europe. The company, if you don't know it, is Julius Baer Group. The ticker is BAERZ, Bears, which I thought was quite nice, being a bull bear kind of guy. Anyway.
Yes, like that.
Now, Julius Baer is the largest pure play private bank in Switzerland and the 3rd largest Swiss private bank. They provide private banking services principally to individuals in Switzerland and Europe and increasingly in Asia and other emerging markets. And the reason it caught my eye wasn't for the discount to NAV, but was actually for the price to earnings growth metric, which we've talked about on the show a few times so far. Now, this is the price to earnings ratio divided by forecast earnings growth. The idea being that the lower you can get this number, the cheaper you are buying forecast growth for, effectively. And Julius Baer Group has got a PEG ratio of just 0.2%, which is incredibly cheap. And in addition, the price is lower than its 2021 levels. And I've got, I can't monitor every single fund and asset manager in the world. It wouldn't be possible. But to me, if this was over in the UK, I feel like some of our listeners would be jumping up and down, screaming, "It's a buy all day long. What are you doing?" And loading up on it. And yet, because it's over in Switzerland, it's not on the UK market. We've not really looked at it and we're not interested. Forecast pre-tax earnings per share are forecast to grow at 125% next year, with a 12% profit margin and a 5.2% dividend cover. A 5.2% dividend yield with cover of 1.9 times, so very secure. Now, I'm not saying it's definitely a takeover target, and I'm not saying it's the best wealth manager or private bank in the world. I'm just saying this is a name I don't hear anybody talking about, and I don't know why. So go away, have a look at it, let me know your thoughts on it, because I think that's a bit of a hidden gem, really. Thoughts, Peter?
Guilty as charged, sir. It's not one I've looked at ever. I've seen the name mentions in circles, wow. I'm gonna have to go and have a look at this, Henry. I'm looking at it.
Excellent.
Stats and financials are sound. We're looking at 1 year, slow and steady. Year to date, up 5%. It's giving you a dividend yield of 5%. If things go pear-shaped in Europe and pear-shaped in America and pear-shaped here, the Swiss always sail on, don't they, and leave everyone else behind. So it's a safety. It could be a safety play, mate, amongst all the carnies that we may get from Europe and America and the political state that we're going to be in the next, 6 to 9 months to 3 years. Oh dear. Right, I've got to find the negative, haven't I? So you can give me a reply to it. It's not a negative, but the PE, Henry, is saying 23.7 for a wealth management company. Yeah. So that's the only thing I can find which makes me go, why is it so? My question is, why is it so high? Is it because it's the Swiss and the best quality, blah, 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 blah. In comparison to our wealth managers, which they were going, there's a reason why they're so lowly managed, because it is a UK fund manager.
We haven't got any wealth
they're
to
7s,
manage.
8s, 9s, 10, 15s, but this is 23, mate. This is 23. It's like Goldman Sachs. I don't know what the PE for Goldman Sachs is, but it seems rich for what essentially is a wealth management company. What's your understanding as to why it's that sort of?
I think it's the pedigree. So this is a 100 and whatever year old, 125, 130-year-old bank. One of the most recognised names in ultra high net worth banking and asset management. And very high quality. You mentioned Goldman Sachs, but to me, actually, the gold standard in the banking space globally, in my head, has always been JP Morgan. I've always heard JP Morgan talked about very, very highly. And to me, Julius Baer Group has got a similar kind of pedigree to it. It's not a little regional rinky-dink thing cobbled together out of loads of, Franken banks or whatever. It's a really high quality, long, steady, stable, well-established bank.
Yeah.
So I suspect that's what's causing the premium on it. But I agree with you. If you look at that PE multiple compared to, say, Jupiter, I think Jupiter's on a PE of like 2.3.
Slow, mate. Slow. It goes back to, I mean, sometimes I've got to pick, because I have this discussion with myself all the time, good and bad, regarding a lot of my investing success been that, I spoke to you about it before, that catalyst of William O'Neill reading the book, and it's basically saying to me how to make, money in any markets. And it's the highest PE stocks tend to outperform the stock market average over the long term. But every now and then I catch myself saying, oh, it's a bit too rich, But long term, the outliers will always be the stocks that everyone else, well, not everyone else, most people have said historically that PE is too high. So yeah, I'm going to have to go back. Oh, sorry, go forward and read that again. Read that data set you talked about regarding Julius Baer, and see what I can find regarding it. Because yeah, and the other thing as well, we mentioned Jupiter being small. This is a behemoth that's done really well over the long term. So the likelihood is that they'll be a very select, as you've seen, they've gone back and you mentioned them buying Merrill Lynch's non-wealth arm back in the day. They'll be an acquirer, Henry. They're not going to be somebody that somebody else comes to buy.
Out. Yeah,
because it's very rare the Swiss sell anything. You don't hear of them being in the market, being taken over that often, and they're here, there, and everywhere. They're going to be acquirers, Henry.
Yep.
So they'll be in the market buying rather than being taken over. So I don't mind saying, and I'm very happy to say this. That's a fantastic stock selection there, mate, that you brought to the table, and it's piqued my interest. I wanted to say no because I've already got Jupiter and others in the space, but that is a good call, my friend. Thank you ever so much for bringing that to my attention, and all of our listeners as well. Good call. Look forward to looking into that a bit more. Right, I am conscious because some of you that are on YouTube might have looked at Henry and thought he doesn't look his more chipper self. He's actually on this pod, weathering the storm, not so well, poorly almost. But he was insistent on us recording this because he's an absolute trooper, as always. So a big shout out to Henry. If you're not following Henry yet, find him on Twitter, find him on X at HTViola and follow his account. And Henry's going to tell you in a minute where he does his occasional writing regarding his own personal blog. The Ethical Entrepreneur, I think it is, on his
indeed.
You'll find that, do a little search under that sort of name and find him and follow him on that. Where do you want to end this, Henry? What do you want to say? Closing discussion to yourself, mate.
Yeah, closing discussion for me is, we had Andy on the show recently talking about discounts available in the market. We've talked today about wealth managers being at a discount, about big blue chips being at a discount. There are opportunities out there, folks, and I feel quite acquisitive at the moment. I'm in an acquisitive mood, and I think there's lots of opportunities in the market. So don't be afraid to go and hunt them down. Don't wait for people to tell you what to buy. Don't be waiting for Investors Chronicle or whoever else to tell you what to buy. Do your own research, find your own screens, come up with your own methodology, and you'll surprise yourself with the opportunities that are out there, because there are plenty of them. But yeah, thank you for tuning in as always. Thank you for your donations to the charity. And thank you also for your kind words to Phil. We hope we see him back soon. But yeah, we've been passing on all the feedback to him that we get through Twitter, through email, and on YouTube. And he's very grateful for your kind comments, as are we.
Exactly. So the one thing I'm going to end with, and brilliant words there, Henry, as well, is the book that I'm referencing all the time and have been referencing on here for some time. And if I'm not, I think if I remember well, I think I introduced Henry to this book. I'm hoping he's got a copy nearby underneath his pillow. Is a global best-selling book, and it is, as I said earlier, How to Make Money in Stocks, a Winning System in Good Times or Bad, by William O'Neill. And basically, to reiterate what I was saying earlier, pre-2000, before I read this book, year 2000, my essence was this, right? Buy low PE shares that pay a little bit of a dividend, and they were safest, and they would generate a great long-term investment return. Okay, post 2001, my investment thesis was turned on its head after reading the book. And the famous quote that twisted me and changed my life financially was William O'Neill's quote, and I will not butcher this, I'm just reading it off bat, is the best performing stocks in history have been stocks trading at a much higher PE than the market. Therein endeth this podcast, ladies and gents. I hope you found some insights from this. We look forward to hearing from you. Please give Henry a shout and reply to him and tell him what you thought about this podcast. Please give me a shout and tell me what you thought about this podcast. And we will look forward to hearing your feedback on YouTube and elsewhere. And please subscribe as you have been doing. And please make a donation. Please make a donation to the Centrepoint charity via Henry's link for fundraising for all the young people, okay, on the Just Giving page. We're going to keep this one short and sweet. I know some individuals are going to be disappointed that we've only done an hour and a bit, but this is the sort of time frame we should be doing for all the podcasts. And we will see you guys in 2 weeks' time. Hopefully the sun arrives, everyone's a lot happier. And don't forget to register to vote, okay? Henry, Mr. Viola Hare, thank you ever so much again, you champion.
My pleasure.
I'll look forward to speaking to you soon. Ladies and gents, take care and God bless you all. Bye-bye for now.
This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.